Okay, good morning and welcome back everyone to our earnings season kickoff call for Q1 of 2021. Interesting earnings season so far in terms of what we've seen in the early reports with the financial firms and some airlines. Next week is really where earnings season kicks off in full gear. So today what we're going to do is just review what our expectations are, specifically what we saw last quarter. Very important to understand not only what the results were, but more importantly, how did stocks react to those results? That, in my opinion, is the information that's going to be most useful for trading each earnings quarter, each earnings season. So let's go ahead and get started and take a look at where we stand. So, before we start off, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So, we'll start off with a quick Q1 earnings preview with the inclusion of Q4's results and what they look like. We'll take a real quick review of the option strategies. I'm not going to spend too much time on the option strategies today. What I do want to spend some time is showing you the type of earnings research that I do before I place any type of earnings trades, and try to go through a couple of examples so that you can see the tools that we use to gauge our directional view and how we believe a stock may perform going into an earnings event. But the primary question that I want to help investors walk away from today is really getting a sense for how do I research and a trade for earnings season, and how do I trade that outlook using limited risk with options. And the key here is that using limited risk is the only way that I will trade an an earnings trade, because it's a very volatile time. It's relatively a binary event, really. If the stock goes in the direction that you expect it to, many times you get a very quick and fast move. Vice versa, if you get the directional view wrong, it could easily move against you very, very quickly as well. With that type of binary event with a lot of volatility, you want to make sure that you have protections against if that view is wrong. And we can always have wrong views here, especially during earnings season. And the important part is not whether you're right or wrong. The important part is what happens if you are wrong and how much are you actually exposed in your trades. And by utilizing options, you can control that amount of risk so that even if you get it wrong, you know exactly how much you have at risk. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today, like I said, I want to share with you my process that I utilize, the high level things that I look at before I trade any single earnings event, from a fundamentals perspective, from a technical perspective, the data points that I look at to gauge my directional view. And one other way that you can kind of learn more about this is by watching us on CNBC every single Friday at 5:30 p.m. on Options Action. Especially with earnings season kicking off now, pretty much every single trade that we'll be doing on Fridays over the next few weeks will be an earnings play. So we'll lay out a specific stock. We'll take a look at whether we have a technical bullish or bearish view. We'll lay in some fundamentals as to why that lines up with the fundamentals. And most importantly, we show you how we utilize options to limit our risk. As I was saying, how we only utilize limited risk strategies when we're playing earnings. So let's take a look at what we saw in Q4 of 2020. That's the last full quarter of earnings release. This was a pretty strong month. This was the first month since the pandemic where we saw year-over-year growth, 6.6% year-over-year growth in earnings, 3.1% in terms of sales. So earnings grew faster than sales. We really want to see sales come in a little stronger. That really will tell us that the recovery is coming along nicely. 10 out of 11 sectors ended up beating consensus. The previous quarter in Q3, we had 11 out of 11 sectors beat consensus. So we're starting to see a bit of a slowdown here. That's to be expected, especially given the first couple of quarters right out of the pandemic is where you expect to see the most beats. Now we're starting to come back a little bit towards normal, but 10 out of 11 sectors beating consensus is still very, very strong. Only energy missed consensus here in Q4 of 2021. Now, 60% of S&P 500 stocks beat both earnings and sales estimates. That's the second best quarter we have seen since 2000. So this is a very high percentage of stocks beating both earnings and sales. The previous quarter was around 66, 67%, but that is, I think, a bit of an anomaly because we're coming out of a recession, coming out of the pandemic. So we're still looking at fairly strong numbers, but they are starting to decelerate in terms of growth, and that's really important. But the most important thing that I think many investors perhaps may not have the data behind it, but maybe you get a feel for this, is that stocks that beat on both earnings and sales only gained less than 1/10%, meaning stocks that beat on earnings and sales did not actually outperform, but stocks that miss on both earnings and sales declined by an average of about 1.3% one day later. Now, this is one of the worst readings we have ever seen since 2000. The only time stocks that beat on both earnings and misses actually underperformed, meaning actually, even though they beat, the stock still went down. The only time that's ever happened was in 2000, right before the dot-com crash. So we're starting to see metrics, while they may not exactly mimic what we saw back in 2000, starting to look like that. And valuations certainly look like that as well. So these are some of the warning signals about, just how much higher can markets go, because corporate earnings and profits is certainly a big part of the driver of S&P 500 growth. But if a lot of that is already priced in, then even if stocks beat earnings and beat their estimates, they're not likely going to outperform. And the early reports so far is exactly what we're seeing. Let's look at the financial stocks. We have seen some very, very large record beats across the board from JP Morgan, from Goldman Sachs, from Morgan Stanley. That's why I took a neutral view here on Morgan Stanley this week on last week's CNBC trade, because again, a lot of this is already priced into the markets. The data is very clear from last quarter that stocks that beat did not move higher at all. Stocks that missed, actually, what is important to also understand is that on average, stocks that miss usually on average move down by about 2.3%. But last quarter, even stocks that miss did not move a whole lot lower. So stocks just didn't move too much with response to earnings. So this is something that we want to pay attention to more this quarter, to see stocks that miss. Do they then decline further? Do they decline around that 2.3% average? Because we have seen just simply below average moves both on beats and misses as well. But again, the most important thing is that this is the worst performance that we have seen from beats since 2000. The only time we've seen worse performance is right before the tech bubble. So taking a look at where we expect this particular quarter to be, this is going to be a very strong quarter simply because last year, Q1 was the start of the pandemic. So it's not, 20% growth in terms of earnings per share versus the same time last year. It's not a particularly, even though this is the strongest year over year growth in terms of earnings per share since, I think, the Great Depression, but still that doesn't mean a whole lot because we're comparing it to the first quarter of the pandemic. But corporate optimism right now is at a record high since 2003. But one of the most important things is really looking at that worst alpha, the amount of gains that we see from beats. The worst alpha suggests that pretty much a lot of the good news is already priced in. If you look at the banking stocks that have reported this week, look at the airline stocks that have been, largely, I would say, the airlines did come in below consensus. They did not beat on consensus, so it is fair to say that those airlines declined. But the outlook, all of the airlines that came in below consensus did show fairly strong outlook here for the rest of the year. And yet, despite that, airline stocks largely still declined here. So a lot of the good news, a lot of the optimism, a lot of the growth that we were expecting has already been priced in. Think about how markets have reacted since November 4th, the election, to now. Markets are substantially higher, but have markets changed substantially since then? Probably not by the amount that the equity markets have moved up by. So this is really where the data is starting to catch up to where the markets have been pricing in. So when we look at the sectors for this particular quarter, where do we see the largest upward revisions? Meaning, where do we see analysts moving their consensus as far as how much they think the revenue and earnings per share is going to come in? Where do we see the largest revisions upward? It's really in communications, materials, and financials. Three sectors that largely have done quite well here in Q1 of 2021. We've seen the most downward revisions in utilities and real estate, but these are two quarters that actually have done two sectors that actually have done quite well here in Q1 as well. So just across the board, we're seeing strong performance across all of the sectors. Granted, utilities and real estate is still the worst performing sector out of all of these, but still not doing very poorly, in my opinion, for a sector. So when we look at ideas within for earnings, it really comes down to finding the right strategy for the directional view that you have. Now, it's not just about directional view either. It's also about how much of a magnitude of a move are you expecting. And this really comes down to the type of stock that you're trading, because when you're talking about technology-based stocks, when you're talking about higher beta sectors or higher beta type names, whether you're talking about highly leveraged names like gold miners, whether you're talking about energy shares like oil companies, those types of or high growth tech names, those are the types of stocks that usually have big moves if you have a large miss or a large beat. Versus if you're taking more of a blue chip like financials, if you're looking at consumer staples, those are the types of stocks that generally don't move a whole lot, meaning magnitude expectations are relatively muted. So when you select an option strategy, it should really be around your expectations of how far you think the stock can go. So generally speaking, when we're playing earnings, we tend to use shorter dated expiration dates. Normally when we buy a call or a put, we usually go about 60 days out. When we're playing earnings, meaning if you're just simply trying to capture the earnings announcement, 2 to 3 weeks after the earnings announcement is roughly where you want to be with respect to earnings. This way you can reduce your risk even further. You have less time for the trade to work out, but you have a specific catalyst in terms of an event that's going to drive that potential move, and you want to get out after that move, because most earnings moves will complete itself within 1 to 2 weeks. That's why we go about 2 to 3 weeks out. So when you expect a big move, when you're expecting a large move, simply buying a long call or a put may be just the best strategy, because it gives you that unlimited profit potential. When you expect a move to happen very quickly, either higher or lower, buying a call or a put is suitable. And you do put a larger amount at risk, but that's why the 2 to 3 week rule comes into play, because when you buy a 2 to 3 week call or put, they're relatively inexpensive. They usually cost a relatively small percentage of the stock's value to trade. They also evaporate in terms of time decay very quickly, but again, you're generally speaking not holding on to these trades for a very long amount of time because you already have the timing roughly set because of the earnings announcement. That's why long calls or puts can be suitable. If you have more of a modest or slower move, when you're trading financials, when you're trading consumer staples, when you're trading utilities and real estate, these types of names that don't move very much, that's when a debit spread may be better suited, because you have limited profit potential, but you're going to put a smaller amount at risk. So usually, when you're trading Coca-Cola, when you're trading Pepsi, you're not expecting this, those types of stocks to move 10, 15% on earnings. You're expecting maybe a 4 or 5% move. Risking smaller amounts to try to take advantage of that 4 to 5% move. That's what you're going to be able to do using a debit spread fairly efficiently and risking a very small amount of capital. And then again, also for expected modest or slower move, you can also use a call or put diagonal spread, which is very similar to a debit spread from the perspective of you're buying a long call or a put, and then you're selling some shorter dated calls against it to try to offset some of that risk. Also limited profit potential and a smaller amount of risk. Both of these trades are very similar, the debit vertical and the diagonal spread. You generally want to enter these trades only 1 to 3 days before earnings. You do not want to buy it 10 days before earnings, because during those 10 days, you're going to be paying time premium, unless you think the stock's going to run up before earnings. And we've seen that a lot, right? Where stocks before earnings runs up 10, 15%. And as the earnings comes out, the stock doesn't move very much. And there are a lot of tech stocks tend to exhibit this type of behavior. But generally speaking, if you're just trying to capture the earnings event, buy the options 1 to 3 days before, and you want to exit usually 3 to 5 days after the earnings event. And then you have more neutral strategies. And this is, a strategy that I think is more suitable for this type of market environment, where we're seeing below average moves, and stocks that beat are not moving much higher. They're much more neutral, if you will. And then stocks that miss are not moving substantially lower either. So, neutral strategies, selling a call or a put vertical, a credit spread may be suitable. This has limited profit potential. It does put a slightly larger amount at risk, but the benefit of this type of trade is that volatility crush and time decay, two things that work against you, generally speaking, when you're trading options around earnings, are the two things that are going to work in your favor. So you're taking on a larger amount of risk, but you have two factors that are big factors to consider when you're trading earnings that work in your favor. And then you can trade a calendar spread for simply just if you expect the stocks to not move. This also has limited profit potential, but it also has limited loss potential. And what it is a risk profile very similar to a short straddle. The only challenge with the straddle is that you have unlimited risk and you have to post a lot of margin to short a straddle. But it's one of the most efficient ways to take a neutral view on the broader markets. But because of that unlimited risk and the high amount of margin that is required to short a straddle, trading a calendar spread gives you a risk profile very similar to a short straddle, but you don't, first of all, you have limited risk and you don't need to post a lot of margin in order to trade it. But for these types of trades, same thing. You want to enter roughly 1 to 3 days before earnings and exit. These you can hold on to a little bit longer because, again, these are neutral strategies. And as long as the stock doesn't move or moves in your favor, you can hold on to these a little bit longer than the other strategies. So just to shift, directions a little bit as far as giving you some insights into how I research earnings, usually my first step is starting with the earnings calendar. I have to look at what's coming up, and usually I'm only looking at the next few days in advance. So maybe looking at Monday, Tuesday, Wednesday at this point, maybe going out to Thursday, but looking at where there's opportunities in terms of earnings. And this is our earnings calendar, which you can access from the OptionsPlay hub. Within the OptionsPlay hub, you have the earnings calendar that you can access. The earnings calendar sorts by earnings date across the top and is color coded for you based on liquidity. Green are the most liquid symbols. Yellow are somewhat liquid. Anything that's not colored is not very liquid. So I always prioritize the most liquid symbols to do my research on. And then what I do is I always start with taking a look at the chart of the underlying stock. And this is really where, when you're looking at the technicals, you want to look at the technicals from a directional view perspective. Do I think the stock is heading lower, or do I think the stock is heading higher or heading lower? But one of the most important things that I use is just getting a quick gauge for where are the trends of both earnings and sales coming in. So for example, Morgan Stanley had a strong Q2, but Q3 was fairly weak and Q4 did not exceed Q2. So a bit of a choppiness in terms of the revenue, and in terms of income, similar type, kind of choppiness this year that we've seen in terms of income and revenue. So usually what you want to see is that if you're bullish on a stock, you want to see strong growth on, generally speaking, both trends, both earnings and sales. If you're bearish on a stock, you generally want to see trends that are either weak or starting to decline, meaning maybe they were starting to rise, but now they're starting to come down. So it's really important, because at the end of the day, when you're trading as a company, a company or a stock price is simply a reflection of future expected value of its earnings. So you should have you should largely have an understanding of how that earnings and revenue is trending. Is it trending higher? Is it trending lower? That should be a big part of your understanding as to whether you want to be bullish or bearish on a specific stock. And I do have this link here up here. If anyone wants to use TradingView, that's what I use in terms of a charting package to see the underlying shares, the stock price, as well as, some basic information about the income statement. You can click on this more financials button here at the bottom if you want to dig into the financials, and certainly some of the ratios and looking at other financial factors are important. But at a high level, you want to see sales and earnings largely trend in the direction that you expect the stock to move in. The second most important thing I look at is relative strength to the sector. And this is really where I use TradingView. TradingView allows me to easily take any stock, in this particular Morgan Stanley, and compare it to its sector, which in this case is XLF. And what it does is it charts for me a chart of the stock relative to its sector. So one of the reasons that I took a neutral view on Morgan Stanley was because recently Morgan Stanley started to break down below support levels against XLF, meaning it was starting to underperform the financial sector. When you see this type of underperformance going into an earnings event, that's usually not a particularly strong vote of confidence for that particular stock, meaning investors going into the earnings event is selling Morgan Stanley at a faster pace than they're buying financial stocks. That underperformance is some clues that we tend to get before an earnings event. Usually stocks that are going to outperform tend to see accumulation before an earnings event. Stocks that are likely to underperform see distribution before an earnings event. So seeing how a stock performs relative to its sector before earnings is an important clue for me. I like to see as many of these things align with each other at the same time in order for me to gain my directional view. So when I look at Morgan Stanley and I saw that the revenues and the earnings were not particularly strong in terms of its trend, when I started to see that it was underperforming the financial sector, that's where I started to see some concerns there. And that's why I took that relatively neutral view going into Morgan Stanley's event. And then lastly, what I do is I take a look at consensus versus analysts. And I use a service called Estimize for this. And this is a free service. Anyone can sign up for it. In order to see data from Estimize, you do need to contribute to the data set. You need to contribute your estimates in terms of earnings and sales in order to see the consensus. And what you get to see is, where does Wall Street currently believe that earnings are going to be? You can see where the company has provided guidance for, and then you can see what the data platform, meaning all of the contributions to the data platform come in. And you generally want to see, consensus, estimized consensus that's relatively far away from Wall Street consensus. When there's a large deviation between the estimate consensus and the Wall Street consensus, that tells me that the market is potentially expecting something slightly different. Those are the times when you see those large beats or large misses, when the consensus is relatively far away from where Wall Street expects. So these are the general services that I look at. And the more things that line up with each other, the more conviction that I generally will have of a beat or miss, in addition to understanding the business. So, and what I mean by understanding the business is, if you're going to go long or short a stock going into earnings, you should have a good understanding as to what does that company do? How do they derive their revenue? And what the environment is that they currently are in, as to whether or not it's favorable for that particular company. So one name that I will point out here is Netflix. I think, and I'm bringing up Netflix just because it's a business that I think most people understand. They sell streaming services. It's a very straightforward model in terms of how they generate their revenue and what they do. They don't have a very complicated business like Disney that has streaming, has parks, has other revenue streams like licensing and branding. Netflix is a pretty straightforward business to understand. So when you are taking a bullish or bearish view on a stock, make sure you understand, how does this company generate their revenue? How does the market currently look for this particular company? And derive some understanding as to those factors and whether or not they are outperforming that particular industry or not. So for example, Netflix, is in a relatively strong, I would say, industry, right? Streaming is an industry that continues to grow very, very strongly here at the moment. But, is Netflix the leader in this particular space? And that's really some of my views, is that Netflix is no longer a leader in this particular space. Netflix created this category. They have been a leader for a very long time. But if you look at the stock here for Netflix, as you can see here, over the past 6 months, so this stock was at $568 back in July of 2020, and let's just say that it wasn't at the peak; it was at 528 back here in July 10th. The stock has moved sideways; it has not moved any higher over the past roughly almost 9 months now. So this is concerning to me when you see, a stock like this, Netflix, compared to the communication sector over that same amount of time. Look at the underperformance. That underperformance is pretty severe, meaning as the sector is outperforming and many of its competitors, looking at Disney, as you can see, Disney at the very least outperforming its sector since that particular time. Netflix is underperforming. This is telling me that things are not, meaning as a Netflix investor, you are losing out in terms of performance compared to its peers. So if you're a Netflix holder, do you still continue to hold on to Netflix while you see Disney Plus, you see Comcast, you see some of the other names in this particular sector continue to outperform? Are you going to keep holding on to the stock that's not performing for you? The answer is that the longer this goes on for, the less likely you're going to do that. And then you have to layer in other fundamentals, meaning how is Netflix growing in terms of earnings? So annual revenue, very, very strong, both earnings and sales. Quarterly revenue, as you can see, slowing down here. Earnings also took a huge hit in Q4, so earnings not as strong. That's also a concern for me here. Even though Netflix is potentially turning around in 2021 and becoming cash flow positive, but still, and then when you look at other data, such as download data versus Disney Plus versus Netflix, not looking particularly strong here for Netflix. We've seen actually declines in Netflix app downloads versus Disney Plus continues to see growth in terms of downloads. So these are all the kind of evidence points that I typically look at to research to determine, do I have a strong conviction of this stock either beating or missing earnings? And the other thing you also have to factor is that you could believe it with very strong conviction that a stock is going to beat on earnings, but then still have the belief that the stock is not going to outperform because that is already priced in. And that's largely what I saw here for Morgan Stanley. I saw that this had a pretty, the stock went from $55 to $80, $81 since the election. Has the market materially changed that much in one quarter for Morgan Stanley? And my views was that it had not, that this had already priced in any potential upside for Morgan Stanley and potentially has actually gone a little overboard in pricing in how much upside there is for Morgan Stanley. And that's why I was expecting a bit of a decline here post a week after earnings. That's my view here for Morgan Stanley. And then when you take a look at stocks like Netflix, that's really where I start to take a look at the overall picture, the lack of stock performance compared to its sector, compared to its peers, the fairly lack of growth from a revenue and a subscription growth perspective. And then you see the download numbers coming in fairly weak here for Netflix. So for those reasons, I believe that this is a stock that could very well underperform its earnings here next week, especially since it's trading near the top of its trading range and potentially revisiting the bottom of its range on earnings. I very well could be wrong, and the stock could rally substantially higher, which is why when I trade an idea like this, I always make sure that I have limited risk. So if it does run up to $600 and continues to move higher here, that I have control over how much risk that I take. And that's really the steps that I take as an investor in any type of options trades. Is this flow of information, looking at just the earnings calendar to see what's coming up and which symbols that I'm interested in, doing that research on the technical perspective, looking at the high level sales and revenue numbers, which is very important to see that trending in the right direction. Relative strength is another thing that's very important. If you see outperformance on a stock that you're bullish on or underperformance on a stock that you're bearish on, that's more that's more of a confirmation that the market is telling you that perhaps you're onto something. And then seeing consensus, especially when you see consensus coming in below Wall Street. And this is for example, Netflix. This is Netflix coming in at consensus below Wall Street. We don't see that very often. Usually consensus comes in above Wall Street. So it's very rare to see consensus below Wall Street. And then you look at the industry, understanding how the company, performs within the industry and compared to its peers. So that's why I was taking a look at Netflix as an example of potential underperformance here for this upcoming earnings season. So, that covers what I wanted to share with you here today. I hope that this was helpful in giving you an understanding as to the upcoming earnings season, what you can look for. All of this information is available to you here within OptionsPlay. And again, I just want to thank our members for taking the time out here this morning and supporting us and allowing us to continue to do this. I hope that this was helpful in giving you an understanding as to how I view each earnings play and the different data points that I look at. Because I've, over the past few years, I've gotten a lot of questions over, how do I actually gain a directional view on earnings? So I really wanted to take the time to show you the steps that I go through. And the more of those steps, it doesn't, at the end of the day, you're not always able to find stocks that line up along everything, but the more things that you line up where, the trend of the earnings and sales are trending in the right direction, the relative strength, the consensus numbers, the industry outlooks, the more of those things you can line up, the higher conviction trade that you relatively will have. And then utilizing an option strategy to protect yourself in case that you're wrong, or in case your research is wrong, that you have limited risk. That's how I've been trading options using earnings plays. And then that's how you're going to see us trade them on options action. So with that, thank you so much. I hope you guys have a great trading day, especially for earnings season coming up. And I'll see you guys here next week.